We are witnessing something extraordinary in the precious metals market. For the first time in recorded history, silver has crossed into triple-digit territory. This isn't just another price milestone. It represents a fundamental shift in how the world values this essential industrial and monetary metal. If you hold silver, you're experiencing validation mixed with uncertainty. If you've been watching from the sidelines, you may feel the fear of missing something important. Both reactions are completely natural, but neither emotion will serve you well in the decisions ahead. This moment requires something more valuable than excitement or regret. It demands clear thinking, historical perspective, and disciplined strategy. That's exactly what we're going to develop together today. We're going to examine what this surge really means. We'll explore the forces driving it, the lessons from similar moments in market history, and the rational pathways forward for different types of investors. No hype, no guarantees, just honest analysis and actionable guidance. Let's begin by understanding exactly what we're dealing with. Silver has been many things throughout human history. It has served as currency, as a store of wealth, as an industrial commodity, and as a hedge against monetary instability. But until recently, it has never been priced in triple digits in any major currency during the modern era. To appreciate this moment, we need perspective. Silver spent most of the late 20th century trading between $5 and $10 per ounce. Even during its famous 1980 spike, when the Hunt brothers attempted to corner the market, silver briefly touched $50 before collapsing. The 2011 commodity boom pushed silver to $49, tantalizingly close to its previous peak. Then came a decade-long bear market that tested the patience of every holder. What makes today different isn't just the price, it's the context surrounding that price. Three major forces have converged to push silver into this new territory. First, the industrial demand profile has transformed dramatically. Silver isn't just used in photography and jewelry anymore. It's essential to solar panels, electric vehicles, 5G infrastructure, and countless electronics. The green energy transition alone has created structural demand that didn't exist 15 years ago. This matters because industrial users can't simply stop buying when prices rise. They need the metal to function. Second, the monetary environment has shifted in ways that favor hard assets. Years of unprecedented money creation, persistent inflation concerns, and questions about currency stability have driven investors back toward tangible stores of value. When people lose confidence in paper, they seek alternatives. Precious metals have filled that role for thousands of years. Third, the supply situation has grown increasingly constrained. Silver mining doesn't respond quickly to price signals. Most silver comes as a byproduct of copper, lead, and zinc mining. You can't just flip a switch and produce more. Combine tight supply with surging demand across multiple sectors, and price pressure becomes inevitable. Markets don't move in straight lines. They move in waves driven by human emotion and collective behavior. Right now, we're seeing classic characteristics of a momentum phase. Early adopters who bought years ago are being validated. Late arriving investors are rushing in, afraid of missing the move. Media attention is intensifying, which brings even more participants. This creates a self-reinforcing cycle. Rising prices attract attention. Attention brings new buyers. New buyers push prices higher. Does this sound familiar? It should. We've seen this pattern in technology stocks, in cryptocurrency, in housing markets, and in previous commodity booms. Understanding this psychology doesn't mean you should automatically assume a crash is imminent, but it does mean you need to think clearly about crowd behavior and your place within it. Are you making decisions based on your own analysis and circumstances, or are you being swept along by momentum and fear? Let's zoom out further and examine the larger economic landscape. Global debt levels have reached historic proportions. Governments face ongoing budget pressures. Central banks are navigating the difficult balance between controlling inflation and supporting economic growth. Geopolitical tensions continue to simmer in multiple regions. Trade relationships are being restructured. Supply chains that once seemed reliable have proven fragile. In this environment, many investors are rethinking traditional portfolio construction. The old assumption that bonds provide safety and stocks provide growth has been challenged repeatedly in recent years. This has created what we might call a search for alternatives. Hard assets, including precious metals, benefit when investors question traditional safe havens. Silver, with its dual nature as both industrial metal and monetary asset, occupies a unique position in this landscape. History doesn't repeat, but it often rhymes. Let's look at previous precious metal bull markets to understand what typically happens during these surges. The 1970s gold and silver boom was driven by similar factors we see today: inflation, monetary uncertainty, geopolitical instability, and a loss of confidence in fiat currencies. Gold went from $35 to over $800. Silver multiplied even more dramatically. The key lesson from that era isn't just that metals can surge, it's what happened afterward. The boom ended in spectacular fashion. Many who bought near the peak waited decades just to break even. The 2008-2011 commodity surge followed the financial crisis and massive monetary intervention. Again, precious metals soared as investors sought safety and inflation protection. And again, the surge eventually reversed, leaving latecomers underwater for years. These examples aren't meant to predict the future. They're meant to illustrate an important truth. Even genuine bull markets experience corrections, and timing matters enormously. What separates successful long-term investors from casualties isn't their ability to predict peaks and troughs. It's their discipline in managing risk and controlling emotions throughout the cycle. Let's dig deeper into the fundamental equation that ultimately drives any commodity's value. On the demand side, we have several persistent trends. The solar industry requires roughly 100 million ounces of silver annually, and that number is growing. Electric vehicles use significantly more silver than traditional cars. The electronics industry's appetite continues expanding. Jewelry and silverware still consume substantial quantities, particularly in cultures where silver holds traditional significance. And then there's investment demand. This is the volatile component. It can surge or evaporate based on sentiment, economic fears, and portfolio trends. On the supply side, we face real constraints. Primary silver mines are relatively rare. Most silver comes from mines primarily producing other metals. This means silver supply doesn't respond elastically to price increases the way oil or some other commodities might. Recycling provides some supply, but it's limited by the amount of silver in existing products and the economics of recovery. Above-ground stockpiles exist, but much of that silver is held by investors who bought as a long-term store of value. They're not necessarily sellers, just because price has risen. When you map these forces against each other, you can see why price pressure has built. The question isn't whether fundamentals support higher prices. The question is how high prices can go before demand destruction occurs or new supply emerges. Silver's role as a monetary asset deserves special attention. Throughout history, silver served as everyday currency, while gold was reserved for larger transactions and wealth storage. The silver-to-gold ratio has fluctuated wildly over time, but silver has consistently held monetary value. Today, silver doesn't circulate as currency, but its psychological and practical role as a monetary metal persists. When investors lose confidence in government currencies, they turn to assets with intrinsic value. Gold gets most of the attention, but silver offers similar properties at a more accessible price point. This monetary demand is highly sensitive to economic and political conditions. It can appear suddenly and disappear just as quickly. This volatility is both opportunity and risk. If global monetary tensions continue or intensify, silver's monetary premium could expand further. If confidence in fiat currency stabilizes, this component of demand could evaporate. You need to understand which portion of silver's current price reflects industrial fundamentals, and which portion reflects monetary premium. The industrial component is more stable and predictable. The monetary component is subject to rapid sentiment shifts. Who is buying and selling silver matters almost as much as why they're buying and selling. The silver market includes industrial users who need physical metal, investors building long-term positions, traders seeking short-term gains, and speculators using leverage in futures markets. Each group has different motivations, different time horizons, and different impacts on price. Industrial buyers create steady, predictable demand. They are price sensitive, but can't eliminate their need entirely. Long-term investors tend to buy during downturns and hold through volatility. They provide stability to the market. Short-term traders amplify momentum in both directions. They pile in during rallies and rush for exits during corrections. Leveraged speculators in futures markets can move prices dramatically with relatively small amounts of capital. They add liquidity, but also volatility. Right now, we're seeing increased participation across all these groups. That's typical during strong moves, but it also means the market is more crowded and potentially more fragile than during quieter periods. A shift in sentiment among any of these groups could trigger significant price movement in either direction. One of the strongest narratives supporting precious metals is inflation protection. The logic seems straightforward. When currency loses purchasing power, tangible assets maintain their value. Silver, as both a commodity and monetary asset, should benefit. The reality is more nuanced. Yes, precious metals often perform well during inflationary periods, but the relationship isn't automatic or immediate. Real interest rates matter, economic growth rates matter, the specific type and cause of inflation matter. If inflation results from robust economic growth and rising industrial activity, that's potentially positive for silver's industrial demand. If inflation stems from monetary dysfunction and economic weakness, the monetary demand might dominate. Current inflation concerns have clearly contributed to silver's rally, but you need to think carefully about what happens next. If inflation moderates, does that remove support from silver prices? If inflation persists, but economic growth slows, how does that affect different components of demand? There are no simple answers, but understanding the complexity helps you avoid simplistic conclusions. For those who follow market technicals, this breakout into triple digits carries significance beyond just the round number. Major psychological barriers often act as resistance until they're broken, then become support. The $100 level has been visible on silver charts for years as a potential target. Now that we've crossed it, technical traders will watch to see if it holds. Volume patterns, momentum indicators, and trend structures all show strength. This doesn't guarantee continuation, but it suggests the move has participation and conviction behind it. At the same time, markets that rise too far too fast often experience violent corrections. Overextended conditions create opportunities for profit-taking and position squaring. If you use technical analysis, you're likely watching these signals carefully. If you don't, the key takeaway is simple. Price momentum can persist longer than seems rational, but it eventually encounters resistance. Your strategy should account for both possibilities. Let's address you first. You've held silver through the long drought. You believed in the thesis when others dismissed it. Now you're seeing vindication. This is actually your most dangerous moment. The temptation to get greedy is overwhelming. You've been right, and you want to maximize your reward. You start imagining how much higher prices could go. You consider adding more to your position, maybe using leverage to amplify gains. Stop right there. Your original investment thesis has been validated. You've achieved what many investors never experience, a substantial gain in a long-term position. The question now isn't how to get richer faster. It's how to protect what you've gained while remaining open to further upside. Here's a framework for thinking about your position. First, revisit why you bought silver initially. Was it portfolio diversification, inflation protection, a speculation on monetary uncertainty? Understanding your original purpose helps you evaluate whether those reasons still apply. Second, assess what percentage of your overall portfolio silver now represents. If it was 5% when you bought, and it's now 20%, your risk profile has changed dramatically without you making any new decisions. Rebalancing isn't about market timing, it's about risk management. Taking some profits when an asset has multiplied isn't pessimism, it's discipline. Consider this approach. Divide your silver holdings into tiers in your mind. The first tier is your core position. This is the amount you're comfortable holding regardless of price fluctuations. You won't sell this portion unless your fundamental thesis about silver's value changes. The second tier is your trading position. This is the portion where you can take profits, reduce exposure, or rebalance without feeling like you're abandoning your conviction. The third tier, if it exists, is your speculative position. This is excess exposure beyond what your portfolio really needs. This is the portion you should strongly consider reducing. This mental framework removes emotion from the decision. You're not choosing between holding everything or selling everything. You're managing different components based on their purpose. Let's talk about the emotional challenges you're facing. You're probably experiencing a mix of excitement, validation, and anxiety. You might be checking prices constantly. You might be calculating what your position will be worth if silver reaches certain levels. These are signs you're becoming emotionally overinvested. The investors who succeed through bull markets aren't the ones who ride every move with maximum exposure. They're the ones who maintain perspective, take profits along the way, and preserve capital for future opportunities. You can be bullish on silver's long-term prospects while still managing your position prudently. Here's another consideration. What's your exit strategy? Not because you need to exit now, but because you need to know what conditions would cause you to exit. Is it a price level, a change in fundamentals, a portfolio rebalancing trigger, a life circumstance requiring liquidity? Without predetermined criteria, you'll make decisions based on emotion in the moment. That's when mistakes happen. Think about position sizing as well. If you add to your silver holdings at current prices, you're raising your average cost basis into a market that's already appreciated significantly. That changes your risk-reward profile. New purchases now carry different mathematics than your original investment. They have less room to multiply before reaching stratospheric valuations, and more room to fall if a correction occurs. This doesn't mean you shouldn't add to your position. It means you should do so with clear eyes about the changed risk parameters. Consider tax implications if you're sitting on substantial gains. In many jurisdictions, precious metals are taxed as collectibles with higher rates than long-term capital gains on stocks. Understanding your tax liability should factor into your decision-making. Also think about storage and insurance if you hold physical metal. As values increase, security becomes more important and potentially more expensive. One more piece of guidance for existing holders. Avoid the trap of anchoring to past prices. You might think, I held through $40, I can certainly hold through $100. But the mental experience of watching a position decline from $120 to $80 is very different from watching it climb from $20 to $100. Paper gains can evaporate, realized gains can't. Now let's address those of you who don't currently own silver, but are wondering if you should. You're feeling the pull of momentum. You're seeing the headlines. You might be kicking yourself for not buying earlier. These feelings are completely understandable and completely dangerous. The worst investment decisions usually happen when you feel like you must act immediately. Let's establish some foundational thinking. First, Why are you considering silver now? Be brutally honest with yourself. Is it because you've developed a genuine thesis about silver's role in your portfolio? Or is it because price is rising and you fear missing out? If your answer includes the phrase, everyone is talking about it, you're probably making an emotional decision. That doesn't necessarily mean it's wrong, but it means you need to slow down and think carefully. Here's a framework for evaluating whether silver makes sense for you right now. Start with your investment objectives. Are you building long-term wealth? Protecting against specific risks? Speculating on near-term momentum? Different goals require different approaches. If you're a long-term investor building a diversified portfolio, silver can play a role regardless of current price. The question is, what size role and at what valuation? If you're seeking inflation protection, you need to assess whether current prices already reflect inflation concerns or whether there's more upside. If you're momentum trading, you're in a different game entirely, with different rules and risks. Understand that buying silver at triple-digit prices means you're buying after a significant appreciation. You're not getting the same risk-reward profile that earlier buyers enjoyed. And this doesn't make it a bad decision automatically. Assets can continue appreciating well beyond levels that seem expensive, but it does mean your margin for error is smaller. Here's a practical approach if you decide silver fits your portfolio. Don't commit all at once. Markets that have moved strongly often experience pullbacks that offer better entry points. Decide on your target allocation, then scale in over time. Maybe you deploy 1/3 of your intended position now, 1/3 if price corrects, and 1/3 if fundamentals continue strengthening regardless of price. This approach removes the pressure to time the market perfectly. It ensures you'll have participation if the rally continues, but you won't be fully exposed if a correction occurs. Think carefully about position sizing. For most investors, precious metals should represent a small percentage of a diversified portfolio. We're talking single digits, not double digits. This is insurance and diversification, not a get-rich speculation. If you're considering a position size that would materially impact your financial security if it declined 50%, you're considering too large a position. Let's talk about the form your silver investment might take. Physical metal provides tangible ownership, but comes with storage, security, and liquidity challenges. You'll pay premiums over spot price when buying and receive less than spot when selling. Exchange-traded funds offer easy exposure without physical hassles, but you're holding a financial product rather than the metal itself. In extreme scenarios, there's counterparty risk. Mining stocks provide leveraged exposure to silver prices, but come with company-specific risks, management quality issues, and equity market correlation. Each approach has merit depending on your circumstances and objectives. Many sophisticated investors hold a combination. If you're new to precious metals investing, simpler is usually better. Starting with a small position in a reputable ETF lets you gain exposure while you develop your understanding. Here's what you need to accept before buying. Silver is volatile, much more volatile than gold or most traditional assets. Price swings of 10 or 20% in relatively short periods are normal, not exceptional. If that volatility would cause you to panic and sell at the worst time, silver is inappropriate for you regardless of price. You also need to accept that you might be buying near a local or even absolute top. Nobody knows. The investors who bought at $50 in 2011 waited over a decade to see those prices again. This isn't prediction, it's acknowledgement of possibility. Your decision should be robust enough to withstand being wrong about near-term direction. Finally, beware of leverage. Some platforms let you buy silver with borrowed money or through instruments that amplify exposure. This can multiply gains, but it will also multiply losses. For most investors, leveraged precious metals positions are a path to financial harm. The volatility will eventually trigger liquidations or force exits at the worst possible times. If you can't afford to own silver without leverage, you can't afford to own silver. Whether you're a holder or a potential buyer, certain principles apply universally. Never invest money you'll need in the foreseeable future. Precious metals can experience extended periods underwater. You need the luxury of patience. Maintain portfolio diversification. Silver should be one component of a broader strategy, not your entire financial life. Focus on your personal situation, not on what others are doing or saying. Your risk tolerance, time horizon, and financial objectives are unique to you. Avoid making decisions based on short-term price movements. Checking prices daily or hourly doesn't improve your results. It just increases your emotional volatility. Stay informed about fundamentals, but don't confuse information with wisdom. You can drown in data while missing the essential truths. Keep learning. Markets evolve, conditions change. Your understanding should deepen over time. Let's be direct about the behaviors that destroy wealth during market surges. The first and most common mistake is making decisions based on emotion rather than analysis. Fear of missing out drives people to buy at peaks. Panic drives them to sell at bottoms. Greed prevents them from taking profits. Hope keeps them holding losing positions. Every one of these emotions feels completely justified in the moment. That's what makes them dangerous. If you find yourself feeling urgency, excitement, or anxiety about your silver positions, those are warning signs. Good investment decisions rarely feel urgent. Using borrowed money or leveraged instruments to amplify your silver exposure is extremely dangerous. Yes, leverage can multiply gains, but it also guarantees that volatility will eventually harm you. Silver can drop 20% in a week without the bull market being over. If you're leveraged, that decline might wipe out your position entirely. Even if you're eventually proven right about direction, leverage can ensure you're not around to benefit. Some investors become so convinced of silver's prospects that they concentrate their entire portfolio into this single asset. This is gambling, not investing. No matter how compelling the thesis, no matter how strong the fundamentals, you cannot know the future. Concentration risk is catastrophic risk. The wealthiest, most successful investors maintain diversification even in their highest conviction ideas. Many investors put great thought into buying decisions, but no thought into selling decisions. Then, when the moment comes, they freeze or make impulsive choices. You need criteria for taking profits. You need criteria for cutting losses. You need these decided before emotion clouds your judgment. This doesn't mean rigid rules. It means thoughtful frameworks that guide your decisions. Rising prices create a sense that your analysis must be correct. Falling prices create doubt about your thesis. But price movement itself isn't analysis. Markets can be wrong for extended periods. They can also be right for reasons different than you assumed. Evaluate your positions based on changing fundamentals, not changing prices. When everyone you encounter is talking about silver, buying silver, making money on silver, the temptation to follow is overwhelming. This is usually the most dangerous time to act. Crowds are often right during the middle of trends and wrong at the extremes. You don't know where you are in that cycle. Make decisions based on your own analysis and circumstances, not on what's popular. Position sizing, diversification, and rebalancing aren't exciting. They don't get discussed in the breathless social media posts about silver's rise. But they're what separates successful investors from cautionary tales. Always know how much you could lose. Always know what that loss would mean for your life. Always ensure you can survive being wrong. Markets that have risen strongly feel like they'll rise forever. Markets that have fallen feel hopeless. Both feelings are almost always wrong. Silver at $100 doesn't guarantee silver at $150. It also doesn't guarantee a collapse back to $50. The future is genuinely uncertain. Your strategy needs to work across a range of outcomes. Precious metals often carry tax disadvantages compared to other investments. In many jurisdictions, they're taxed as collectibles with higher rates. Understanding your tax situation should factor into your timing and sizing decisions. Don't let tax considerations override good investment strategy, but don't ignore them either. Buying and selling physical silver involves premiums, shipping, storage, and insurance. These costs can eat significantly into returns. ETFs have management fees. Trading involves spreads and commissions. Factor all costs into your return expectations and strategy. We've covered substantial ground together. Let's bring it all into focus. Silver's move into triple-digit territory is historically significant. It reflects genuine fundamental shifts in supply, demand, and the monetary landscape. It validates the thesis that precious metals maintain relevance in modern portfolios. But significance doesn't equal simplicity. You now face choices that will impact your financial future. The quality of those choices depends not on predicting silver's next move, but on understanding yourself. What are your genuine objectives? What risks can you truly tolerate? What role should precious metals play in your broader financial life? These questions don't have universal answers. They have personal answers. The investors who build lasting wealth through volatile markets share certain characteristics. They think independently while remaining humble about their limitations. They act on analysis while acknowledging uncertainty. They take risks while managing consequences. They don't try to extract every possible gain from every move. They don't abandon their strategy when markets test their patience. They don't confuse volatility with risk or price with value. Most importantly, they separate their emotions from their decisions. Right now, emotion is running high across precious metals markets. That's natural given the price action, but it's also dangerous. Your task is to find the calm center within the chaos. If you hold silver, honor the patience and conviction that got you here. Protect your gains while remaining open to further upside. Let your predetermined strategy guide you, not the daily price fluctuations. If you're considering entry, move deliberately. Understand what you're buying and why. Size your position appropriately. Accept the uncertainty inherent in any investment. If you're watching from the sidelines with no position and no desire for one, that's perfectly valid. Not every opportunity is appropriate for every investor. The market will always offer new chances. Your job isn't to catch every move. It's to make wise decisions suited to your circumstances. Let's acknowledge something important. Nobody knows what happens next with silver prices. The smartest analysts disagree. The most sophisticated models produce different projections. The future remains fundamentally uncertain. This uncertainty isn't a problem to solve, it's a condition to accept. Your power lies not in predicting the future, but in preparing for multiple futures. Build a portfolio that can prosper across different scenarios. Manage your risks, control your emotions, stay disciplined. Markets move in cycles, rallies end, corrections occur, new opportunities emerge. This is the eternal rhythm of financial markets. Your goal isn't to time these cycles perfectly. It's to participate thoughtfully, protect yourself adequately, and compound wealth steadily over time. Silver's current surge will eventually end, either in a correction, a consolidation, or an ongoing climb to levels we cannot imagine. All three possibilities are plausible. What matters isn't which possibility occurs. What matters is that your strategy works regardless. That's the essence of robust investing. Not predicting, preparing. As we close, remember this. Wealth building is a marathon, not a sprint. The decisions you make today will matter not because of their immediate results, but because of how they position you for the years ahead. Stay informed but not obsessed. Stay engaged but not emotional. Stay opportunistic but not reckless. Trust in your analysis. Respect the uncertainty. Honor your discipline. The markets will do what they do. Your job is to navigate whatever comes with intelligence, patience, and perspective. Silver's historic move into triple digits is a significant chapter in market history, but it's just one chapter in your longer financial story. Write that story thoughtfully. Write it with discipline. Write it with the understanding that true wealth comes not from catching every trend, but from making wise decisions consistently over time. The path forward is yours to choose. Choose with clarity, choose with conviction, choose with the calm confidence that comes from genuine understanding. This is how lasting wealth is built, not through speculation and emotion, but through strategy and discipline. The opportunity before you is real. The risks are equally real. Your success depends on respecting both while maintaining your focus on what truly matters, your long-term financial well-being. Now you have the framework. Now you have the perspective. Now the decisions are yours to make. Make them well,